Good afternoon, everybody, and a very warm welcome to all of you. So, as Netra proudly celebrates its third anniversary, we wanted to mark this occasion with a tribute to a man who embodies the spirit of lifelong learning, Charlie Munger. In the spirit of his quote, the best thing in life is to learn to constantly learn how to learn. Every contributor to this edition embarked on a deep dive into Munger's philosophy. I, for once, read a book by Trent Giffen, who I believe has perfectly described the greatness of this man in the following line: a man who knows a lot about a lot and he knows a little about nearly everything. To celebrate his timeless wisdom, I'd let Sahil take over and take you through his lessons on investing and way beyond that. Over to you, Sahil.
Thank you, Pragriti, and thanks to all the viewers and listeners and readers of DSP Netra. And as you know, this is the third anniversary edition. And in each of the earlier anniversary edition, which was the first one, we covered timeless investing principle from Bob Farrell. In the second anniversary edition, we spoke about the timeless investing principle from numerous greats. The report was called "Standing on the Shoulders of the Joint." In the third anniversary edition, as Pragati just spoke to you, we distilled wisdom from Charlie Munger and wrote a tribute to Charlie Munger. And we were fortunate to see a number of investors in India who are well regarded and well known in the industry to contribute to this edition. So in today's session, we are not going to talk about markets. We are not going to talk about cycles. We are going to talk about some investing wisdom from Charlie Munger. And to read the whole report, you can go to the dspim.com website and read the whole stuff. I'm going to probably cover a number of sections from what we wrote, and I've jumbled up a number of ideas from the report. And I will present some of the learnings that we've taken from Charlie, and I hope that all of you can, take at least one insight from it and apply it in your investing professional and personal lives. So we'll kick off with a number of ideas that Charlie wrote. And as I said, each year on the anniversary edition, we intend to step back, zoom out, and focus on some timeless principles. And this edition is again a similar attempt to do the same thing. So for Charlie Munger, once Jason Zevig asked him that if he could write his epitaph on his gravestone in less than 10 words, what would it be? And Charlie Munger said, I tried to be useful, should be the epitaph. And he didn't say that I was useful, which he said that it is for others to judge. And this, I think, is one of the cornerstones idea behind how Charlie Munger, and for that matter, even Warren Buffett operates. They've been very, very direct in terms of what they are seeking. And they are always about execution. They are always about, doing the right stuff. And over a period of time, Charlie Munger has given some ideas which have been, spoken about as the right stuff. That means things that we should be doing, which could help us in becoming better investors and probably better human beings. And I will try and cover some of this right stuff through the next few slides that we've made some case studies. We've also looked at a number of ideas. And this is more like a report that you will read and, look at all these quotes that we've taken. And in most of these quotes, the idea will arise that many very smart investors have learned a lot from Charlie Munger, including Warren Buffett, where he says that, if you look at the quote at the heading and look at the last line, where he says that we were both going to behave better than if we didn't know each other. So the idea is Warren Buffett said that being with Charlie Munger allowed him to behave better, both in terms of his personal life and both in terms of his investment conduct. So this is something which is a remarkable achievement for learning from Charlie Munger and at the same time, exercising all that wisdom in real time. So all the quotes that we have used in this report are from Charlie Munger, unless otherwise stated. They are the other people, they've been given credit for that. The title of each of the following slides, as I said, is the right stuff that Charlie Munger espoused and he wrote about. And Warren Buffett, as you can see, once said, Charlie and I think pretty much alike, but what it takes me a page to explain, he sums up in a sentence. So we are also trying to be brief today, just to give the crux of, what are the most important ideas, and we want to emulate that same idea. So first slide I took from, few of important, voices within the DSP. First comes from Kalpain, where he says that the most important lesson that he took from Charlie Munger is principle of inversion, and where Charlie said, "Invert, always invert." This is a very famous, often quoted quote where he tries to look at, the same problem from a different angle, from the reverse angle. So, and internally at DSP, as Kalpen says, that he has tried to look at various aspects of investing and try to look at it from a different lens. So incidentally, when we speak to investors, the biggest focus for all investors at most points in time is always on returns. Very few investors think about the time that they spend in investing. And when you look at the compounding formula, more often than not, you will see that it is the time which causes the compounding to happen, and not only the return. Return is a important factor, but the biggest overriding factor, which is raised to the power, which is T, which is time, I think that is more important. So the principle of inversion uh, has also helped in creating certain products, right? So, for example, thinking about how to eliminate the bad stuff, I think is one of the most important starting point for creating great structures. So, internally at DSP, we've always focused on how structure can beat activity. If you build the right structure, the strong foundation, whether it is an investment portfolio or an investment product or a team, usually over time it will last and it will create above average performance. So that is one of the core ideas borrowed from Charlie Munger in action. Also, Abhishek Singh, our fund manager, he says that Charlie lived deliberately. He consistently shaped the future he wanted, and that I think is one of the most important aspects of Charlie Munger. That his life and lessons have both been very consistent. And as you can see, we've written slightly more detailed stuff here that Charlie Munger also chose where he vacationed, how he lived. He also created a number of architectural buildings about rethinking how colleges should be made. So one very important takeaway is that whatever Charlie espoused, he acted on it. It's more than just looking at the menu. It is about actually eating the dish. So what this means is that a lot of people, more often than not, either learn a lot but do not exercise that, or many of us don't even learn. And Charlie Munger did both things correctly. Repeatedly learning a lot and then exercising and executing that learning over a very long period of time. So these two principles are extremely important. That means looking at the same thing from various angles, or probably inverting the problem. And second is learning and then executing. I think these two are some of the most important lessons from internally from DSP that we gathered. Now going to some of the important, the right stuff which I spoke about, we will cover them in the next few slides. And one of the often repeated phrase in investing is long term. A lot of people think about being long term investors and long term investing, and it's one of the most difficult things to do because hyperactivity often gets the better of even the most disciplined investors, and we tend to act on various things. As you saw last week, the turnover at various stock exchanges will tell you the same story. uh, what does long term oriented mean? And I have some data also on this screen which I will talk about, but there is a James Bontier quote at the top which I would want to somehow talk about. And he says that the penultimate hurdle is myopia. That means thinking which is too short term. This reflects the idea that consequences which occur at a later date tend to have much less bearing on our choices the further into the future they fall. So because we can't see into the future, we generally end up thinking about the present. And James Montier clearly says that it can be summed up as eat, drink, and be merry, for tomorrow we may die. And I think this is one of the principles which a lot of people live their life by. And more often than not, people forget that investing and living are two different activities. Investing is sometimes an inversion of principles of so-called the modern happy life, where enjoyment and short-term gains is what all people value. In investing, the further you go, that means the further you delay your gratification, there are chances that your outcomes will improve. And that is what James Montier says here. And there is one more Charlie Munger quote which says almost all good businesses and investors engage in pain today and gain tomorrow. And this is the right long term thought process to be emulated rather than the other way around, where a lot of investors also think about gaining today and forgetting about what could be the pain going ahead. Um, so one of my personal favorite quotes from Charlie Munger has always been this quote, which I've put here. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. So one example of avoiding being stupid for a very long period of time is just to use the SIP route or dollar cost averaging or systematic investment plans to invest. So we looked at data from about last 30 years and number of countries, and we've taken the same universe in the last edition where we showed point-to-point returns over a period of time. And this time what we are showing is uh, longer term SIP returns. And as you can see, there are few countries who've delivered double-digit returns like Brazil, Mexico, India, Indonesia very close at 9%. And when you look at these are lump sum returns. When you look at SIP returns, you will see that there are some countries which have delivered SIP returns 11%, which are again double digit: Mexico, Indonesia, India. And in case of only two countries, SIP returns have been higher than lump sum returns in these cases. So it clearly shows you that SIP works much better than a simple, long-term investing strategy. Or even when, you are trying to be extremely smart, SIP will usually give you a much smoother journey and provide you returns which are much better. Even, for example, in markets like Japan, which have not generated significant long-term returns, you have 6% SIP returns and even 5% inflation adjusted returns, which are quite handsome for a Japanese investor, even in US dollar terms. What is the underlying logic? And we have written it very carefully here that most investors will be better off by doing away with all activity and hyperactivity. Often during our interaction, we've seen that clients and partners, we usually highlight that if you are a systematic investor and you start a SIP, which means you start a SIP and you never stop, and the operating word is never stop, right? Then you don't have to do anything else. You don't have to listen to any experts or read any reports. What you're accepting is, including DSP Netra, as I've written here. That's because by averaging your investments through SIP, you are accepting average valuations, average returns, and average volatility. So over a longer period of time, you will probably come and meet the market in terms of averages, and which could be a meaningful return for most investors. And the reason is that most investors don't even make average returns. So long-term orientation, I think, is one of the most important fundamental concepts that Charlie Munger and Warren Buffett both have lived by, and it clearly shows in the returns as well. Although this interpretation of long-term investing is our interpretation, although Charlie Munger never spoke about SIP, but the idea is that we will, by doing SIP or systematically investing, what we are trying to do is trying to be less idiotic over a period of time rather than trying to be very, very smart. So that, you know, does the work. It helps you stay invested. And please remember that the operating word is to not stop it, right? If you stop it, then SIP does not work. You cannot time it. It has to be done forever, started and never stopped. The second um important quality or the lesson that we learned is being frugal and risk averse. And this is something which is, very core to Berkshire Hathaway as a whole. And we've taken a very, very important quote here. And you can see that Charlie Munger says that Berkshire Hathaway is very risk averse. And he says that we try to behave in such a way that no rational person is going to worry about our credit. So if you see that they say that and after they have done that, they also behave in such a way that if the world suddenly didn't like our credit, we wouldn't even notice it for months because we have so much liquidity. So Berkshire Hathaway has always had huge amount of cash pile, largely the way they have constructed the entity. And that even with that cash pile, they have been able to outperform S&P 500. They have also been able to outperform S&P 500 on the downside, which means their drawdowns are lower. And he says that it's just part of the culture to survive. And here also Charlie says that excess cash is an advantage, not a disadvantage. Right. So this is something which is core to uh, Charlie Munger's teaching, that being double sure, that means having double layer of some kind of a reinforcement helps you uh, survive for a very long period of time. And if you go back and talk about survival, it is one of the most important conditions for time. You will be able to spend a large amount of time in the market when you survive over cycles, and that is how compounding happens, right? So there is a very nice story that Warren Buffett told in 1989 Berkshire shareholder letter. He says, and I quote, "Every 2 years, I am part of an informal group that gathers to have fun and explore new subjects. Last September, meeting at Bishop Lodge in Santa Fe, we asked Ilk Friedman, Bosham's managing genius, to come by and educate us on jewels and the jewelry business. He decided to dazzle the group, so he brought from Omaha about $20 million worth of particular fancy merchandise, which is jewelry. I was somewhat apprehensive. Bishop's Lodge is no Fort Knox, and I mentioned my concern to Elkan, our opening party, the evening before his presentation. And he took me aside and he said, "See that safe?" He said, "This afternoon we changed the combination, and now even the hotel management doesn't know what it is." The and I bred this ear. And he went on, he says, "See those two big fellows with guns on their hips? They'll be guarding the safe all night." I was now ready to join the party. This is what Warren Buffett says. But he leaned closer and says, and besides Warren, he confided, the jewels aren't in the safe. So this is one of Berkshire's portfolio companies, and you can see that not only double layering, but this guy has a triple layering in terms of the reinforcement that he created for the jewelry that he brought. So this is a culture that's not just in quotes and in lectures from Charlie Munger and Warren Buffett. This is the culture of the company. This is how they have ingrained uh, conservatism. This is how they have ingrained the ability to remain rational because they have sufficient amount of reinforcement at all points in time. And I think this is one reflection, a very important lesson for all investors, including people who are sometimes swayed by market swings and uh, get too much into one single asset rather than thinking about what will save them in bad times. The next is playing to strengths and non-ideological, and this is, I think, again uh, a proven strategy. They have proven time and again, and we will see two such examples in this presentation. And here they say that if you read this quote, knowing what you don't know is more useful than being brilliant. Acknowledging what you don't know is the dawning of wisdom. This is what Charlie Munger says. In 2000, most investors had written off Berkshire Hathaway when it was underperforming Nasdaq. Very similar outcome happened in 2020. You can see that some new age technology businesses were outperforming. Many new investors had started to say that Warren Buffett's time is passé and he will not be able to come back and outperform. And you can see that those businesses haven't really lasted for a very long period of time. And these guys, just by sticking to what they know, were able to outperform by a very, very large margin, right? And this is something which is significantly proven over time, that if you invest in your strengths, eventually you will come out better. And this is what these two guys have shown, that they again and again play to their strengths. There is also a fundamental concept, which I relate to very closely. Most people think about working on their weaknesses and try to overcome that, and spend a lot of time fixing them. But Charlie Munger and many similar, stalwarts have repeatedly pointed out how playing to your strength or honing your skills is a much far greater skill to acquire or execute, rather than only thinking about working on your weakness. It's a split house. A lot of people have different opinions, but I think playing to strength is possibly one of the most important lessons that you can take away from Berkshire Hathaway, Charlie Munger, and Warren Buffett. The next one is capacity to suffer. And here it says, if you are going to be in this game, which is investing for the long term, which is the way to do it. That means only the long term is the right way to do it. You better be able to handle a 50% decline without fussing too much about it. And I don't think a lot of people ever imagine a 15% decline. It's very easy to read about it and think about it. A lot of people don't believe it can happen. And that I think is some amount of a fallacy. And we looked at these 10 largest listed companies in India, even in US, and you can see that most large companies have seen more than 50% decline at least once in their lifetime. Many have seen many multiple times. And I also received a question that, what these are mostly from global financial crisis. What happened during other cycles, right? The numbers will not look so bad. But ideally, if you look at from other cycles, these are only the surviving companies. If we go back to other cycles, there will be companies which did not even survive. So their drawdowns are nearly 100%. So these are just this is a survivorship bias data, which also has 50% plus declines. So which tells you that even the companies which have come out on top, they also go through massive amount of volatility and very large declines. And this is something that Charlie Munger has said, that it's a non-linear world. That means even the upside or the downside both are going to be non-linear. And one very important quote from Warren Buffett, which I think is very, very important, it says the availability of a quotation, which is stock price tickers, should never be turned into liability, whereby its periodic aberrations in turn formulate your judgments. So what he's saying, that by looking at the stock price on a tick by tick or a daily basis, if you're going to act, that is not the best way to exercise investing. And this, I think, is a very powerful statement, because over the last 20 years, stock price availability has gone up significantly. And not only investors react every day, they react every second. And that creates hyperactivity, but not long-term returns. So the idea is that you should be ready to suffer, which is a 50% decline or higher, even in the best companies. And that is how this long-term investing works. The next is Collegial with a sound temperament. And this, I think, is probably one of my favorite parts. And the above quote is very interesting, where it says that even Einstein didn't work in isolation, but he never went to large conferences. Any human being needs conversational colleagues. I hardly know anybody who's done very well in life in terms of cognition that doesn't have somebody trusted to talk to. And you could, probably read the whole quote. And he also says that Warren and I aren't prodigies. We can't play chess blindfolded or be concert pianists, but the results are prodigious because we have a temperamental advantage that more than compensates for lack of IQ points. And he also says, maybe possibly coming up, that many very high IQ people may not be great investors, because as he says, that the higher points or the better quality to have in investing is temperament, not only intelligence. And this is one point that has come repeatedly from Charlie Munger again and again, where he says that temperament is something which probably creates a better edge rather than only IQ points. And he also says that people calculate too much and think too little, which again tells you the same thing, that a lot of people say कि इतना क्यों सोचना है, which again is a probably a misnomer. And Charlie Munger probably is telling you to think more rather than just calculate. And um, if you look at this data, which has two lines, what we've done is that we've looked at one buy and hold strategy and then one buy and sell strategy. The buy and sell investor, which is the red line, what he's doing that he books profit at every 50% gains and then reinvest when the markets are down by about 15%, right? So he's trying to time the market again and again. And the buy and hold investor is doing nothing and he's gaining a 2.5 percentage point alpha. And the primary reason for gaining this alpha is the tax arbitrage. Whenever you sell, you pay taxes. And if you do not sell over a very long period of time, that extra alpha gets added to you, and then you eventually pay it only once when you exit. And that's why he says that big money is not in the buying or selling, but in the waiting. In the blue box, what we've said that many people who do not have the temperament in investing can benefit a lot by using a financial planner or a partner. And I think that is possibly one of the biggest, upcoming opportunities in India, where a lot more investors can benefit by creating reinforcements through people who understand what temperament is for investing. And that I think where this the first quote which I quoted, that even Einstein did not work in isolation. So investing could become more meaningful if you can add people or advisors who can correct your journey, improve your journey over a very long period of time. And as I said at the beginning, a lot of people pay a lot more attention on R, which is returns, very less on time, which is actually raised to power in the formula, and which I think is showcased here. That if you have the temperament and you stay invested for a long period of time, wonders can happen. And for that, you need the right temperament, and for temperament, probably a sound financial advisor. The next one is from Contrarian EPS or contribution. We have contribution from about 10 people in this edition. I am not covering all. You can go back and read the report and you'll be able to understand their point of view on how they look at teachings from Charlie Munger. So here he says that you have to work in your circle of competence. So Charlie's quote here is, to get what you want, you have to deserve what you want. The world is not yet a crazy enough place to reward a whole bunch of undeserving people. And this, I think, is again one of the important maxims of investing. A lot of people believe that whatever index returns are occurring, those returns are automatically going to come for them. And this, I think, is a big fallacy. Going back to the temperament point, that I think is one of the most important requirements. And another very important fact is, do you even deserve those returns? Do you have that psychological edge? Can you do the opposite of what the market is doing? Can you invest when the opportunity has very high margin of safety? Can you step aside from market euphorias? I think those are some of the analytical edges that need to be built over a long period of time. And one way of doing it is to become, as quoted earlier, rather than thinking about being very, very smart, just trying not to be stupid could be a good idea, right? So as Seth Klarman says, that if you can't beat the market, at least be the market. So one way is to exercise it through by using a multi-asset allocation strategy. And we've shown in data here that over long periods of time, multi-asset allocation delivers slightly inferior returns than equity over the full cycle with much lesser volatility. I think these are the outcomes that not many people know, that even a multi-asset allocation strategy can give you a very smooth ride over a period of time if you stick to it. And this is a message again, uh, but you have to define what your circle of competence is, right? There are investors who understands, let's say, banking or pharma or metals, and they can do a great job in these sectors and become great investors, but all of us cannot, right? So we need to understand our circle of competence. If that circle is very small, which means that you are not a professional investor, then you need to understand structures which will be helpful for you to stay invested for a very long period of time. One such structure is multi-asset allocation, and data shows that it delivers superior returns adjusted for the volatility in the portfolio. The next comes from Ramni Kundra, who is our CIO for DSP Pension Fund. And a lot of people sometimes are blinded by very high IQs, by narratives, by stories. And as I quoted earlier, a lot of Charlie says a lot of people with high IQs are terrible investors because they've got terrible temperaments. And also, Ramneek has picked a very, very beautiful point, which is very contextual, at least in the present market, where Charlie says that bull markets go to people's head. If you are a duck on a pond and it's rising due to a downpour, you start going up in the world, but you think it's you, not the pond. And I think this is very important, especially in bull markets. And I have seen this happen many a time that when a big bull market happens, a lot of people believe that they are the ones who are causing the extra alpha or extra returns, not the market. And I think that is a fallacy. When the pond rises, everything goes up, right? And this has happened time and again. And here, data has shown for a number of new age company stocks which outperformed significantly, but eventually they collapsed because they did not had the underlying earnings, underlying cash flows, and they were available at very expensive valuations. Eventually, these companies did not do well and could not even beat the broader market. And Nasdaq outperformed all of them over time. So it's very, very important to know, what's happening, what is moving the market, rather than, ascribing everything right happening to one's own ability. I think it is more widespread than a single investor's ability to create meaningful returns over time. Um, the next one is patient, discipline, and ready to learn from mistakes. And it involves a case study of Dexter shoes. So Berkshire Hathaway purchased Dexter shoes for $433 million in 1993. Their idea was it's a great company with limited competition. And it also seemed to have pricing power in the main based area where it operated. But as soon as Berkshire, took over this company by paying by its own stock. So Berkshire Hathaway, gave 25,230, 25,203 Class A shares of BRK in lieu of Dexter shoes. And soon enough, the Chinese competition took over. The Chinese created very low cost shoes, which competed with them. And Dexter's shoe was not able to compete by keeping its margins. And eventually, it went down the drain. And you can see Berkshire Hathaway, the opportunity cost is about $16 billion today for what they paid for 433 million, which was a very costly mistake, right? And this is exactly what Charlie Munger said about this episode. He says that we learned how awful it is to have somebody who's really way lower priced, which means that they were pricing their products lower, come in hard, and how no amount of managerial skills could protect us, right? And this is something which they have repeatedly said. uh, they have highlighted that if you have a great manager but a lousy business, which means the sector is not so powerful, it will be the reputation of the business which will last and not the manager. So, and in many other places, they have highlighted that they need a business which is profitable and can create value over a long period of time, even if it is run by an idiot, because eventually it will be. So, one lesson that they have clearly stated is that they want businesses which are superior. Uh, for example, Dexter Shoes seemed to be a superior business to them, but it did not turn out to be. And they learned from their mistake that you cannot undercut on pricing and create a great business. So eventually they uh, you know, wrote it off, corrected their mistake, and tried to avoid this in the future. And this is something, again, a great lesson from Charlie Munger, that you learn from your own mistakes and try and not repeat them. Probably try and look at doing something different in the next cycle by using the learnings that you have taken in the last lesson. So the next comes from another case study in PetroChina, and this was the first investing that BRK, Charlie Munger, and Warren Buffett did in China. And so they bought PetroChina shares, which produced 3% of the world oil at that point in time. and they were earning about $5.7 billion in profit. And it was trading at a price to earnings ratio of 6.5, right, which is like ultra cheap, and at least on price to earnings ratio. And they say that while low valuations do not guarantee good returns, uh, the PetroChina underlying business fundamentals were very, very sound, according to them. And Berkshire had thus far never invested in China, and they said this was no-brainer. They bought a 1.3% stake for 488 million, and by 2007, the company's market cap was 275 billion, right? They made a huge amount of money on this bet, and if you read the whole case study, they will say that they never met the management for this purchase when they purchased it initially, and they read the annual report, uh, which was available in English, and they said that at that point in time, not many people even had read that, right? They were uh, even the publicly available information was so superior in terms of the price at which the stock was trading, that this became a no-brainer bet. And as he says, the wise ones bet heavily when the world offers them opportunity. They bet big when they have the odds, and the rest of the time they don't. I think this is very important. As the title says, calm but courageous. They keep on waiting for a very long time, but when they get the right opportunity, they bet heavily, and they have done this again and again. They did that in Apple again, as all of us know. And good investing requires a weird combination of patience and aggression, and not many people have it. And most of the time, we've seen that when recent returns are very high, people jump to equity. They want to increase their allocation. And when things go wrong, markets fall significantly. Most people want to redeem and go to the safety of bonds or not invest in stock market. And we've seen various cycles, from when equities become the flavor of the season, and then equities become the bad word, in various cycles. And more often than not, investors who are patient are able to purchase investments at bargain prices, because others are selling when it is actually the right time to buy. And probably this lesson is more important at this juncture, looking at where the markets are trading in terms of valuations. The next is one of my favorite readings, and probably the last one, which is the lesson from Charlie Munger, which says, read. And Charlie says life is just one damn relatedness after another. And Charlie Munger has championed a cause called multidisciplinary approach to learning, where he says that you acquire workable mental models from various disciplines. So you learn about physics, biology, probability, mathematics, psychology. As Pragati in the beginning said, this is a guy who knows a lot about a lot of things, and he knows a little about everything. And that is how he has functioned over time. And why did he do so? And he says that because of the Lollapalooza effect. What is that? These are the really big effects, which means that they have confluence of factors, many things coming together at the same time. So in various businesses, industries, in our own life, there are moments when everything is going to go right. In order to see those trends, or in real times feel those trends happening, you need to have multidisciplinary learnings from different fields, and that gives you the ability to connect the dots and understand that this actually is the big thing. And that, I think, gives them confidence, at least has given confidence to Charlie Munger and Warren Buffett to exercise what they say, patient and aggression at the same time. So I don't think there is any better way to develop a multidisciplinary approach rather than reading a wide variety of books on different subjects. And to read is to have self-respect to grow, and it's a passion to know. And as you can see, here Charlie says what matters most, passion or competence that was born in. Berkshire is full of people who have peculiar passion for their own business. I would argue passion is more important than brain power, which is again another expression of IQ versus temperament, which Charlie Munger has spoken about. And I think if there is one overarching lesson from Charlie Munger that serves as gateway to acquiring all other lessons, it is reading. And as Charlie has said, developing into a lifelong learner through voracious reading, cultivate curiosity, and strive to become a little wiser every day. And this, I think, is probably a lesson which, if imbibed, can help you reach all other lessons that we have spoken about today. And I think there are other multiple dozens of lessons that we can take away from Charlie Munger. Um, in the end, in many occasions, when Warren Buffett gave mic to Charlie Munger, he had this statement, "I have nothing to add," where Charlie Munger always was very brief in terms of his viewpoint and ideas. And this is with this quote of Charlie Munger, we'll end here. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.